Good evening, everybody. It's Scott Gillum with the ShadowTrader short video for Tuesday, the 17th of June. Today's topic, defense. And how do we play defense in the market? We buy insurance. How do we buy insurance? We use the put option to do that aspect. So buying puts gives us the right to sell as the market declines in value. Let's take a look at the SPY, the ETF for the S&P 500. A Fibonacci setup here back from August of 2024 with a touch once again April 21 of 25. We've seen this thing move almost to a full 100% retracement from that all-time high swing high that's on this chart. As we move back below the 8, getting close to the 21, my eye moves to this level at 576 or about 575, which was the reversal after the gap up that we had from May 8th out here to May 12, then the full retracement once again back on the 23rd, and we've taken off. We are losing momentum in this market. Hence the defensive posture. So how do you play this situation with potential rollovers and catalysts to the downside? Speaking of catalysts, what do we have out there going forward? We've got a debt ceiling that still has not been moved higher in the big beautiful bill that's going through Congress now. We've got an FOMC meeting coming up in July, August, and September, plus one tomorrow. That's on Wednesday the 18th. By the way, the setup for this trade should be looked at or reviewed after Chairman Powell makes his 2:30 speech tomorrow. Everything could change and this market could explode both up or down, thus negating all the setup that you're going to hear. Other catalysts, we've got the tariff, stay of execution from the Liberation Day back on the first part of April. That is out on the 9th of July. So how do we set this up? Taking a look at the SPY. I would like to do something that is going to take advantage of a drop in value for the SPY and go out as far as I can in time that makes sense. Well, here's the criteria for this hedging situation. We could do a long put. That's buying a put at a strike that is about 5% out of the money, or thereabouts, with an expiration 60 days or more. Yet that's only about a 50-50 shot of breaking even or even making money. I don't like those odds. So how would I set this up, and how are we going to set it up here? It's using a put spread. Yes, buying that long put out such that it's about 5% out of the money with an expiration out 60 days or more, yet marry that with a short put that is closer in expiration, anywhere from 1 to 2 weeks, staying at the same strike price. So let's set this up for you. Take a look. We're right now sitting on this SPY around 600. So let's go to the trade page. How would we set this up? Going out 60 days, well, that puts us out here to August 15. I'm going to go another month out. I'm going to go out to September because that's the end of a quarter, the end of the futures contract. That is the end of the next quarterly earnings, and things should have settled down. Plus, I have theta decay, which is very, very low at this point in time. So if we take a look at the September 19, go from the 600 down 5%, that's what, 30 points? There's your 570. And buy this put for around, let's say, $12, just to round things out. All right, that's an expensive purchase. That's $1,200 to protect a portfolio. It does give you, though, a nice 100 delta to use for hedging. But, as I said in the setup, if we go this far out, we should also be able to mitigate some of that expense by using something shorter term. So let's look at the July 1st 570. Here we can mitigate $2 of that 12 and bring us down just below $1,000 for that insurance policy. This puts now you are participating in a potential downside, but you're doing it for about 20% less than the total cost of the long put. Let's move forward. If this expires and we stay above 570, you keep all of this premium. So we do this again. So our second iteration, go out 14 more days. Again, I like to use Tuesday, Wednesday, or Thursday expirations. Mondays are a little bit crazy. Things are wonky after a weekend. Fridays are crazy because of options expiration. So an easier and more beneficial option to use selling is Tuesday, Wednesday, or Thursday. So if we go out to if we go out 2 more weeks, 14 more days, that puts us out here to July 18th. That's the monthly. Let's back up and let's go to the 11th. 24 days out. If we do the same thing, the 570, currently we could pick up something like $3. Forget the $3 number. We've gone 1 week's worth of theta decay. If we pick up another $2, that now drops our price down to around $8. All right, let's go. There's 2 weeks. There's a second iteration. Let's go 2 more weeks. We go out to the 25th. Same thing, $2. We're down to $6. $2 after August 1st. We're down to $4. $2, and you can't get in between here because of the spreads. The expirations aren't every other week. So $2 on the 15th, $2 on the 22nd, $2 on the 29th. By the end of August, all of this debit of $9, $10 should be back in your pocket. Therefore, anything that happens from the end of August into that 19 September expiration should be profitable for you, even though we don't go below that 570 strike on this put spread. So once again, rollover impending. Like to take some insurance on my portfolio. Buying a September 5% out of the money put. Selling the current week or next week's same strike and reducing that debit. Insurance on your portfolio. Hi there, this is Scott Yellow from the Stock and Options Room of Live Trading Suite. If you enjoyed this video, please hit the like and subscribe buttons down below. And if you'd like to trade live with me in real time, click again that link in the description below. Good trading to you all, and I'll see you in the room.